that we recommend for clients, we just don't have all of the answers. And what we're trying to do for the next 2.5 months, and really for the entire year, is to look at what we think is going to happen and put our clients in the best position. So first and foremost, where we are is President Biden ran on a platform of helping the middle class and also assessing tax revenue to against the ultra wealthy and the high wage earners to help pay for a lot of the infrastructure that they're looking to enact. A lot of people have heard about the $3.5 trillion budget bill that was introduced that may come in at $2.5 trillion. It may come in at $3 trillion. We don't really know. As it goes through the modifications through the House and through the Senate, obviously certain programs and certain changes may or may not happen. What we do know for certain is that something is going to change, and we need to try to be in the best position to plan for that change. So before we talk about changes, one of the questions that I get all the time is, if we're making estate planning gifts, if we're taking advantage of the current law, how nervous should we be about an audit? And up until September 13th, 2021, I would have told my clients, and I do tell my clients, that the IRS does not have the budget to fully look at every 709 that's filed, which is your gift tax return. When an individual makes a gift greater than $15,000, that gift is reported on a Form 709. With the IRS and with COVID and the employees not working in DC and throughout the country, it's been very hard to judge what will be subject to an audit and what wouldn't be. Then when you look at the historic budget of the IRS, they just don't have the money to hire the qualified agents that they used to have many, many years ago. And there has been a freeze for many years. Then you look at the estate tax world, which the original exemptions were at $1 million. Well, back in the day, they were at 600, going back 25 years ago. Now they were at $1 million, and we'll talk about how those increased over the years. But in 2018, those numbers went to close to 11.7 million per person. So one of the concerns is, well, what gifts are the IRS going to look at? And when they look at these gifts, what's the liability? And I could easily sit back and tell my clients, you can be aggressive. You can take substantial discounts. Unless it's egregious, chances are it's not going to get picked up on audit. Also, when looking at the gifts and looking at the discounts, we as taxpayers present our case. We file a tax return, we present our experts, and if we have substantial documentation and it looks good, that's one of the boxes the IRS will check. And again, the chances of an audit may be very slim. But under the bill and what was released out of the House Ways and Means, which was over 2,700 pages of tax law changes, the current budget for the IRS is going to be increased by $80 billion. And so you go from today to 2031 with the implementation of an $80 billion budget. We now have an annual budget that is 90 times or 90% greater than the budget that we had, last year and in the last couple of years. What's that budget money going to be used for? It's going to be used for examiners, upgrading computer systems, the ability to generate notices, and create certain flags on 709s and on reporting. Now, it's not all geared towards the estate tax department, but a substantial amount of this will get caught in audit now. So that does raise a big concern as you become more and more aggressive, especially towards year end, that there will be substantially more people and more resources looking at the returns and potentially putting people through audit. Prior to 2021, there was a 2% chance your estate tax return or your gift tax return would be caught in an audit position. What's going to happen going forward is it's going to put you closer to a 20% return likelihood of an audit. And that's a real concern for us. So what are some of the major changes that we're looking at going into 2022? The first change that's going to affect all the high earners is that the marginal income tax rate will increase from 37% to 39.6%. Now, that's not a Fed stats number. You will find as we go through this presentation that there are additional percentage points that get racketed up as you earn more money or over for certain transactions. So right now, we know that there's a increase in the income tax from 37 to 39.6, and that is going to affect wage earners that are married with $450,000 of income. It will also affect head of households. Will hit that top bracket at $425,000, and unmarried individuals will hit that at $400,000. What really concerns me, and in my world, is the estate and trust world. We've always had low brackets for an estate and trust, and this goes back to many generations when wealthy people would set up small little trusts or to transfer assets into the trust to potentially ride up the income tax brackets, inside the trust world. Congress condensed those brackets, and now a trust that earns $12,500 effective January 1st, 2022 will be at the highest income tax bracket of 39.6%. Now, in our world, we have something called grantor trust, and I'm going to explain that in a little bit. But up until this point, we were always able to push the taxable income out to the children or to the grantor of the trust, and we wouldn't have to worry about this very low bracket. But with the repeal of some of the grantor trust rules, we're going to have some issues. All right. So the other change that we need to worry about is the capital gains rate. The capital gains rate is going to go to 25%. So if you have a transaction that hasn't closed yet, but you have a binding contract, that tax will be assessed at the current rate. If you have a sale that occurs after September 13th, I'm going to talk about that date in a second. If it occurs after September 13th, then the capital gains rate could be 25%. Please remember that these are only proposals. It has to go through Congress, and also has to be accepted through the Senate before President Biden actually signs the bill. Now, why is the September 13th date? That is the date that the Ways and Means Committee put in the bill. There are 3 dates that we need to be concerned with when looking at any of these changes. The first date that we have to worry about is September 13th. There are several bills and recommendations that use the Ways and Means date of September 13th. There are several other dates which are the enactment of the bill into law. We don't know what that date is going to be. Back in over the summer, we assumed it would have occurred by now. We're seeing a lot of back and forth with the Democrats, even that they don't have the full 50 votes in the Senate to be able to pass it. And there is a concern that there'll be some negotiation. These dates may be negotiated, but the reality is that this bill should pass sometime before the end of the year, or some version of this bill. Now, I indicated before that the top bracket is going to be at 39.6%. There's going to be an additional tax for high wage earners of an additional 3% on top of that. So with the capital gains rate, if you have a certain level of income, and for capital gains rate, if you're earning $450,000 of income, there could be an additional surcharge of 3% over that. For trusts and estates, the income, let me rephrase that. For trusts and estates, it's going to be adjusted income over $100,000. For married individuals, it's over 2.5 million. It's not the 450. And then for married couple, it will be 5 million. The Biden administration also is looking at the estate taxes and changing it. If you remember, during the summer before President Biden was elected, Bernie Sanders had come out with reducing the estate tax exemption from the 11.7 million that it is today to 3.5. Most practitioners believed the 3.5 would be the number that would bring us back to the 2009 rates. The House Ways and Means proposed a number of 5 million, which really is an acceleration of the current law. The current law said in 2018 that the exemption would go to $10 million indexed, and then it would roll back to $5 million in 2026. It seems like a reasonable compromise to lower that number now as part of the proposed budget bill. Before I really dive into all of the changes in the estate tax rule, I do want to talk about one more income tax planning issue that's important to discuss. So we talked about a second ago, and I'm going to just go back a slide. We talked about the capital gains rate going up to 25%. And we also talked about an additional surcharge of 3%. There's also going to be a phase out of 199A. 199A was meant to provide a benefit to small businesses, to pass-through entities. 199A allowed for a 20% offset of income for businesses such as partnerships, LLCs, and S corporations. And the goal was that it was to kind of even the playing field between the C corporations, the big companies of the world, and a lot of the smaller companies. And what the 199A deduction allowed is that you could deduct 20% of your income, again, subject to certain phase outs, and you would pay taxes on 20% less of what you earned. Now, with the phase out of the 199 cap A at certain income levels, it could have a very chilling effect on small businesses. So let's take a doctor, for example. If a doctor, if he qualified for 199A, and if I'm gonna use simple numbers, the threshold for a married couple is 500,000. So at 500,000, there would be a phase out. So if you have $500,000 of income, you have a cap A deduction of 20%, that would have been $100,000. It would have reduced your taxable income to $400,000. Under the current structure, if you have a doctor earning $500,000, let's just assume for every day he works over a calendar year, he gets $100,000. And this is a cliff. Once you hit this number, there is no, it's gone. So if you have a doctor that's earning $500,000 and he'll pay income taxes on $500,000. If he was to work 4 days a week instead of 5 days a week and earn $400,000, then his taxable income would be based on $320,000 because he would be able to take advantage of that 199 cap A. So as you're going through and planning at the end of this year, you need to look at, if this bill passes as it's currently anticipated, you need to look at what money you're going to be earning and what that benefit of the 199 deduction. There may be ways that you can shift or modify your adjusted gross income so that you can still, so you wouldn't shift out of these tax benefits. The real issue for me on the 199A is how it relates to trust and estates. So for a trust and estate, the cap is not 500,000, it's actually 10,000. So if I have a operating business that qualifies for 199A, if they earn more than $10,000 of income, they will not get that 20% reduction. So for the last several years, we've been putting a lot of businesses into our trusts. And if they are now in a gifting trust for the benefit of the children, we need to be concerned that they that we can somehow structure it so they will qualify for the 199 cap A, because there's a huge delta between $10,000 and $500,000. So that's really important that you have meetings with your tax advisors over the next few weeks, few months before January 1st hits, so you can plan properly. The other issue to keep in mind is, in addition to the cap gains rate, that there's going to be, as I said, a 3% surcharge, which we just talked about, and then we'll talk about now the estate tax planning opportunities. Starting in 2012, the estate tax exemption went to $5,120,000. That number has been indexed for inflation and has increased up until this year, which is now $11.7 million. A married couple could transfer 24 point, sometimes it's hard to do math on the fly, but $23.4 million tax-free to their children and loved ones. That tax also is the same tax that you would have for gift tax, which is lifetime transfers. And then there's a third layer of tax when you leave money to grandchildren. All three taxes were, and they will remain to be, all coupled together, so that if you use your gifting while you're alive, you will not have it when you pass away. So one of the things that we want to look at is, how do we take advantage of using this exemption before it disappears? And towards the end of the presentation, I'm going to give you several ideas that we can use to help eliminate or at least take advantage of this vanishing exemption. We have a concept called a grantor trust. A grantor trust is a trust that works to remove assets out of your estate. It's a completed gift at the time of formation, but it also is an incomplete gift for income tax purposes. So that when I have a grantor trust and I put money into the trust, the grantor is still taxed on all the growth, appreciation, and all the tax attributes. It does a lot of beneficial things for estate planning. When you make a gift to the trust, and you have a tax liability associated with that. For example, you have $1 million portfolio, it's in a grantor trust, earns 5%, there's $50,000 of income. That $50,000 of income in a grantor trust will be reported by the grantor of the trust. He'll receive or she'll receive that income, she'll pick it up on her personal 1040 and pay taxes. The grantor trust acts as a conduit, as a almost like an IRA for the next generation, because those assets will grow without being reduced by income taxes. The huge benefit for the grantor and the family is the payment of those income taxes is really an additional tax-free gift. So the IRS has never liked these rules or the dichotomy. They've tried to fix it, several times. But it looks like the current legislation is going to repeal the grantor trust rules and create taxable situations for clients. So here's the good news. The good news is that this is one of the provisions that will be effective upon enactment of the bill. So we have time to plan for this. We personally, in my firm, are doing several transactions a day in which we are using grantor trust, because we know that the grantor trusts that exist prior to the enactment will be grandfathered. So all of the prior transactions, all of the deals that we've done up to this point are still fine. The issue is going to be that if you add additional money to a grantor trust, it's going to cause problems for the next generation. Also, when you have a grantor trust and you pull money out of the grantor trust, the IRS is saying that that will now be a gift when the money comes out. But the bigger issue is when you make additional contributions and that gets commingled, the grantor trust will be included in your estate for tax purposes. So with the grantor trust, the whole point was that we were able to put property in, it would grow outside your estate, and then you had the income tax benefits of that. And then when you passed away, all the appreciation was escaped your trust. There is some side effects that we have to be concerned with. The first is that there's certain planning opportunities that will now be eliminated. The first one is going to be, that we have to worry about, is insurance trusts. Every insurance trust is a grantor trust. By definition, under Code Section 677A, that if the trust income can be used to pay for life insurance, then the trust is what we call a grantor trust. If that's the case, that every year when you make an additional premium gift to the trust, you are going to jeopardize that grantor trust status, and the insurance proceeds, when they pay out at death, will be included in your estate for estate tax purposes. The whole point of doing an insurance trust was to remove those assets from your estate. The other transaction that we believe will be eliminated are GRATs. A GRAT is a grantor retained annuity trust. The GRAT allows for the grantor to receive a benefit for a period of time, and then the property would pass at a reduced transfer tax to the next generation. So what we need to think about is what we can do in the next several months to set up these GRATs and set up these insurance trusts so that they will be grandfathered. And the other thing that we have to be careful of is that if the grantor trust does terminate prior to the death of the grantor, or if a distribution is made from the trust, the full value of that amount could be treated as a gift and could be included inside the estate. The other rule that will affect the grantor trust rules is that when we sell assets to a grantor trust, there was an exception. So I cannot sell an asset to my wife and she cannot recognize a gain or loss on that sale. The basis is not affected by that sale because the related party rules say that when you sell something to a related party, you don't recognize gain or loss. The grantor trust is considered a related party. And when we were selling assets back and forth, we weren't paying capital gains. And it allowed us to transfer a substantial amount of wealth without triggering a capital gains. Under the new rules, a sale to a grantor trust will be a taxable event and will recognize either an income or loss based, well, it won't be a loss, but it will recognize income as if the asset had been sold to a third party. Again, these only apply to trusts created on or after the enactment of the bill, and any contributions to an existing trust on or after the date of the trust. There are going to be ways to still use the grantor trust, especially ones that are already grandfathered. We would be able to, we could still sell assets and recognize a gain, which may not be a bad thing because the trust would take a new basis. But we could lend money to the trust as opposed to making a contribution. That would be a way to get assets into the trust. And if the assets can grow greater than the stated interest rate, we still have certain appreciation that will be outside of the taxable estate. For many years in planning with family businesses, we have taken something called a lack of marketability or a lack of control discount. So that when I buy a business, let's just assume it's an unrelated party. If I were to buy a business, I would determine a fair market value. Let's say the business is worth $1 million. I would pay $1 million for that business, and that would be with a third party, and everything would be fine. If I'm going to buy half of that business from that same third party, my next door neighbor is selling me his access to his cabana. I'm going to pay, the cabana is worth $1 million. I'm going to take a half interest in that. I will probably not pay $500,000 for that because I can't sell it when I want to sell it. I don't have complete unfettered access to it. And I don't have the right to make any decisions on that piece of property. The IRS has now said that in regards to family transfers for passive businesses, you can no longer take a lack of marketability or lack of control. Let me give you a different example. For the last year, with the knowledge of what may come down the pipe, we have been setting up family holding companies. We'll set up an LLC. We'll put marketable securities into the LLC. We then get a business appraiser to determine what one unit of that LLC is worth. Let's assume that he's going to say that one unit does not have control. One unit does not have real market because no one wants to buy 1% of a family holding company. So they would give a 20 or 30% combined discount on that one unit. We would then take that discount. So we use our same $1 million example, $1 million of property. 50% of that would be $500,000. A 30% discount on that would bring us down to $350,000, let's say. I would then use that $350 amount and either sell it to my grantor trust or give it as a gift to my grantor trust. And I would file my 709 with the IRS. I would take a lack of control, lack of marketability, and those were generally accepted principles, and they have been for many years. And a lot of accounting firms have divisions that will actually prepare those reports for us. The IRS is saying that that will no longer apply. If you have passive assets, which could be triple net real estate, it could be marketable securities, it could be certain family businesses, you will no longer have the ability to take those discounts. Now, for active businesses, you still can take a discount. However, that if there are assets inside the active business that are passive, for example, let's say you have a car dealership, that's an active business. If you're transferring that to a family member, you could take a discount for lack of control and lack of marketability if it's a fraction. However, if that car dealership also has a marketable security portfolio of $5 million, and that's part of the value of the dealership, you would not be able to discount the marketable securities or the passive assets. There is an exception for reserves for the, for ongoing businesses, but in general, if there are passive assets, you're going to have to identify, and potentially you're going to have a discount associated with that. It's a little bit beyond the scope of what I want to talk about today, but I think that I'd be remiss not to say that you must sit down with your financial advisors. If you're a financial advisor, you must sit down with your clients and talk about IRAs and retirement benefits. The IRA rules are going to be very draconian. They're going to have very, very harsh minimum distribution rules that we haven't seen before. So right now, if you have a taxpayer that has adjustable taxable income of a married couple of 450, a single person of 400, if the aggregate of their IRA account exceeds $10 million in the preceding year, the IRS is going to require you to distribute out at least 50% of that amount. There are going to be additional rules if you exceed $20 million. So, and one of the opportunities that wealthy people had was to distribute money from IRAs into Roth, and those back doors are now going to be eliminated. So these are effective January 2022. So as the rules become a little bit more fine-tuned, I would not go and start pulling money out of IRAs today, but you should be aware and have that conversation as this law comes into play. And hopefully there's going to be several weeks, if not months, before the law becomes enacted, that you can know whether or not it would apply to you or not. But $10 million is one of the thresholds. $450,000 is your taxable income. Now, keep in mind that if you're able to adjust your taxable income through other distributions or other accounts, then you may be able to avoid some of these rules. And obviously, the $20 million, you'd have to bring it down to a $10 million number. So in the last few minutes, what I'd like to do is I want to cover several planning opportunities that may vanish. So one is going to be the spousal lifetime trust. This is a trust created for a spouse. The grantor retained annuity trust that we've already talked about, life insurance trusts, gifting trusts, and some outright gifts. So this concept really became popular in 2012 when we were afraid that the estate tax was going to be repealed or drop back down to $1 million. A SLAT is what we call a spousal lifetime access trust. It is just an irrevocable trust. Mom creates the trust for the benefit of dad. Dad could create a trust for the benefit of mom. Instead of it being and transfers between spouses are typically tax-free. So I could transfer to my wife $20 million. She could transfer $50 million to me. We would have no tax liability for making those transfers based on a concept called the unlimited marital deduction. That rule, we're not looking at that rule. What we're saying is we want to use our lifetime exemption. So we're not taking a deduction, we're actually making a taxable gift. We would make a taxable gift, let's say of $11 million into a SLAT. And the SLAT could be drafted in numerous ways. It could be solely for the benefit of your wife or your husband. It could say mandatory income. It could say discretionary income and principal. We can add in children or grandchildren. We can add in relatives, cousins, nieces, nephews, parents, grandparents. There is no limitation on the class of beneficiaries. You just need to delineate who gets the money and under what standards. Typically, the standard would be that the SLAT would be created for the health, education, maintenance, and support of your spouse, and then also discretionary payments for the benefit of the children. Very important that you look at what rights your wife or husband have in the trust, because there is a second concept you need to be concerned with, which is gift splitting. So you can give, one person can give away $11.7 million. Both husband and wife can each give away $11.7 million. Sometimes one spouse has more assets than the other. So a lot of times what we'll do is one spouse will create a trust for the other spouse and put in the full exemption, the $23.4 million set aside for that spouse. And we can use both spouses' credits for doing that. It's a very handy technique, but you need to be very careful that these trusts, when drafted, if you're going to gift split, have certain rules and regulations that a lot of the slats don't have. So you need to know how you're going to report the gift, who's putting money into the trust, and then how money is coming out of the trust. The choice of trustee is very important. You can let one spouse be a trustee for the other. You can have a friend, you can have a relative, or even a corporate fiduciary. A lot of my clients that are funding these with the full exemption amount, because they want absolutes and they want to be certain, we're putting that all of the income will get paid out to the spouse. Why are we doing that? That goes against pure estate planning rules, but we're doing that for comfort and for ease of administration. Also, we're protecting it on some of the grantor trust rules. The other issue with the slat is that because the exemption is vanishing, most spouses aren't, or most clients aren't worried about, all the future appreciation. They're just looking at that, preserving that $5 million of exemption that may be available. So key points on a slat: who are the trustees? How are you funding it? One or both spouses, and whether or not you're going to file a 709 that you gift split or you don't gift split. The other issue with the slats, if you fund it prior to your end, is you need to be careful if you're taking discounts that the new code section doesn't apply prior to you making those transfers. Oops. Grantor retained annuity trust, or GRATs, this will end. This is something that will end at the end of the year. A GRAT is an effective means to transfer funds out in which a grantor keeps an annuity for what we used to do it for a very short period of time. They were called rolling GRATs. Now I would recommend that you consider, lifetime GRATs or long-term GRATs. The IRS assumes that property put into a GRAT will grow. When we prepared these slides last month, the interest rate was 1.2%. This month it's 1%. It's the 75/20 rate. Next month, in November, it goes up to 1.4. Anything over that 1.4 or that 1.2% is deemed to have assets coming out of principal, and that will lower the gift. And with discounting and with other techniques, these were wonderful tools to get substantial assets out of your estate. The next technique is a gifting trust. So a gifting trust is similar to a slat, except instead of putting your wife or your husband as a beneficiary, you are creating trust for the benefit of grandchildren or even your children. And the terms of those trusts can be incentive trusts, in which when children hit certain thresholds in their life, they earn a certain income stream, put money for retirement, they get married, they have children, money can come out of these trusts, or they can stay in trust for their lifetime and pass multiple generations, through multiple generations. And in Florida, they can exist for 360 years. The final topic is just outright gifts. If you have children that are in a good place in life, you're not worried about divorce or creditors, and you are worried about the $5 million, the exemption going from 11 million down to 5 million, now's the time to just write a check, put a piece of property, just a straight transfer of assets to the child or the grandchildren or the family. You will have $10 million that will escape taxes when you die for a married couple. And if you know that there are family vacation homes or properties that you want to pass out that are under $10 million, now is the time to consider doing that. And one of the techniques that we're looking at right now with a client is they have a $20 million vacation home that they want to keep for multiple generations. They have an insurance trust to fund the upkeep and care that was set up a couple of years ago. Instead of putting it into a trust or holding it until they die, they're actually just transferring it to the next generation today, so that the children can use it because mom and dad are not using it the way they used to. And this way they're able to take advantage of $10 million of that passing tax rate. So that concludes my presentation. What I wanted to do is I had several questions that I was provided prior to the presentation, and I thought what I would do is just raise those questions, give some quick answers to them, and then open it up to question and answers for anyone that is in attendance. So the first question that I was provided is it too late to harvest capital gains at the lower 20%? And the answer is probably. Although it's not an actual bill at this point and the law hasn't been enacted, the capital gains threshold date is September 13th. So unless you have a binding contract in place, it seems unlikely that you will be at the 20% level. We believe that, if the bill passes in its current form, if you're selling a business or a home or a piece of real estate or stocks or bonds, and it occurs after September 13th, the capital gains rate for those transactions could be at 25%. The second question that I had was, should I continue to engage in estate planning? And the answer is absolutely. If you have credit, if you have assets, now is the time to do it. As I just said, for a married couple, there's going to be close to $11 million of credits that vanish. You should try to figure out a way to make that happen. And then one question which is somewhat interesting is, if you've used all your lifetime credit and the credit changes, will you be subject to a tax? And that was answered in 2012. There is no clawback that's in the current bill. We do not believe, and I would be shocked to see anything in which they try to claw back the the difference between the new $5 million credit and the 11.7. And the other thing which I thought was interesting is what is not in the bill. So the House bill didn't have everything that Biden ran on, and there were a lot of things that we thought would be out there that aren't out there. So one of the things to think about is what was omitted and could it end up in the final bill? And the first question is step-up basis. When you sell a piece of property, you pay capital gains based upon your basis. When you die owning that property, the basis gets reset at current value. There had been a lot of talk with Bernie Sanders about repealing the step-up basis rules. That was not part of this current bill. The other question that we didn't see was relating to like-kind exchanges. We knew that there was going to be substantial changes to the ability to do a 1031 exchange. It wasn't in the bill the way we thought it would be, but it still could end up in the final bill. And the final thing that we were surprised in the bill, though not in this current bill, which we hope is in the next, is going to be the SALT deductions, the state and local tax. We're hoping that there would be some reprieve that, for the people in New York and California that are paying large income taxes, that there would be some offset against your federal income taxes. That's not in the current bill, but out of all the things you hope in a bill, hopefully that will be in the next bill. So I know we had roughly about 30 minutes for the presentation, and then 15 to 20 minutes for questions and answers. So Jenny, I'll turn it back to you to open up the mic if you want to see if anyone has questions and answers.